Let's now look at an impairment of one of our leases and see how to reflect it in our lease tracking workbook. Recall that the second lease we recorded was for 2,000 square feet of office space in Austin. That lease commenced on February 1st, 2026, and the term is 60 months. Now let's assume that it's March 1st, 2027, and we've made a business decision to reduce our staff in Austin. At this point, we're only using half the space. The other half is vacant, and we have no plans to sublease it. And we believe this reduction in staff is permanent. The vacant portion may function as storage or something similar, but it's no longer serving as office space for our employees. Well, under ASC 360, a change in the intended use of the asset is a triggering event that may require an impairment assessment. For our purposes, let's assume we've completed that analysis and determined that the right-of-use asset is impaired by $80,000. So we record the impairment entry by debiting impairment expense for $80,000 and crediting the right-of-use asset for the same. Let's do that in our accounting system now. Here's our balance sheet as of March 1st, 2027. And you'll note that our Austin building right-of-use asset balance is $168,626.50, which, if we compare to our lease workbook, matches our figure as of February 28, 2027. But now let's make that impairment entry. So this will be on March 1st, 2027. We'll debit impairment expense for $80,000 and credit our Austin building right-of-use asset. And if we save and close, you'll see immediately post-impairment, our Austin building right-of-use asset balance is now $88,626.50, exactly $80,000 less than it was before. So now we need to update our lease schedule to reflect the impairment. As we've done in the past for any other schedule change, we'll update our sheet name to 2.1, copy a version into our archive section, rename that to 2.0, paste over our entire archive sheet with values, and highlight this February 2027 row orange. Then for our 2.1 worksheet, we'll highlight this a different color to note it's a modified schedule. We forgot to do that for our 1.1 schedule as well last time we were looking at this, so let's do it for both. We'll just give it this light orange color. Then we will freeze everything pre-impairment. So that's everything up to February 2027. Change these rows to a light gray background. Highlight this final period pre-impairment orange, and split our schedule into pre- and post-impairment sections. Then we'll start our post-impairment schedule at 0, set this opening date to our effective date, change the first period to the month end of the same month as the effective date. We'll highlight these just for inconsistency. And then finally, we'll zero out our interest calculation here in our period 0 row. Then because we've stolen a row here for our post-impairment opening balances, we need to add one at the bottom to ensure we get to the end of our lease. And then while we're here, we'll change this first total row to our post-impairment totals. We've been using a sum-ifs formula to ensure we only sum anything on or after the effective date. Then we'll lock our cells and copy this over. And now we can add a row for our entire lease schedule. We'll call this lease totals, and simply sum up over the entire lease term. Then finally, in our liability section, we need to update this long-term balance to only grab anything after the effective date. So we'll just add one more criterion for the date and just ensure that it is greater than or equal to our effective date. Then we can lock our cells and copy this down to the bottom. Okay, with our liability schedule ready, let's go revise our lease list. The measurement trigger is an impairment. The effective date of the impairment is March 1st, 2027. And at that point, the remaining term is 47 months. Then nothing else changes here. Because an impairment does not impact the lease liability, we don't reassess the discount rate or the classification. So now back on our 2.1 worksheet, we'll update the identifier. And then let's ensure that our payments begin on March 31st, 2027. So our $3,800 payments have ended, and our $3,900 payments begin March 31st, 2027. Remember that this lease is paid in advance, so the March 31st payment applies to the month of April. Now, because our discount rate, lease term, payments have all remained the same, the opening balance of our lease liability immediately after remeasurement for the impairment is identical to the ending balance on our original schedule as of February 28, 2027. The schedule will continue exactly as before. And if we just spot check a random month, let's look at April 2029. You see we have interest of $485.93, principal of $3,664.07, and an ending liability of $78,853.84. If we go look at the same month on our original frozen schedule, you see we get the same numbers, $486 in interest, $3,664 in principal, and $78,854 as an ending liability. And this is exactly what we expect because an impairment does not impact our lease liability. So we only really need to worry about our right of use asset and lease expense changes. So for the right of use asset, let's delete the calculations from this section and we'll rebuild this. We begin with the ending right of use asset balance immediately before impairment. So we'll say pre-impairment balance and set this equal to the ending balance in our orange row here, $168,626.50. Then we need to subtract the $80,000 impairment. And now you can see our opening right of use asset immediately after impairment is $88,626.50, which should match our balance sheet after recording the impairment entry. And if we look here, indeed it does. So back in our workbook, we'll set our opening right of use asset balance to our newly impaired calculated amount and zero out the amortization in the period 0 row. Now, after we do that, you'll notice that we're no longer amortizing the right of use asset to 0 by the end of the lease term. But this is an easy fix. After an impairment of an operating lease, we simply amortize the right of use asset straight line over the remaining term of the lease, exactly as the standard requires. So in our right of use asset section, we'll add a monthly amortization calculation and set it equal to the opening balance divided by the remaining term of 47 months. Now we can set our amortization every month equal to this amount, and we'll lock that cell, and we can copy it down. And you'll see we're now successfully amortizing our right of use asset to 0 by the end of the lease term. So at this point, we can really delete our operating lease expense calculations. Because after an impairment of an operating lease, we no longer record a straight line operating lease expense. Instead, we record operating lease expense as the sum of our interest and amortization for the period, very similar to how we record a finance lease. So all that leaves is our check. Let's first set the lease expense and cash payment items to our final row. And you'll notice the total lease expense we'll recognize over the lease term does not match the total consideration we'll pay under the contract. And this is because some of our expense is now being captured as impairment loss instead of operating lease expense. For our check to work here, we need to capture everything that flows through the P&L related to this lease. So we'll add a row for impairment loss and set it equal to the $80,000 impairment, just flipping the sign. And now you can see when including all expenses related to this lease, both the operating lease expense and the impairment loss, we're again matching the total cash consideration paid under the contract. And that's it. Now we have our updated schedule and we can follow this going forward. So let's look at our periodic journal entry. If we update our identifier here to 2.1 and update our reporting date to March 31st, 2027, the first period after impairment, you'll see everything's calculating correctly. But something different than it was before impairment, if we add up the operating lease expense and then move forward 1 month, you'll notice that the operating lease expense recorded on our income statement now changes from month to month. This differs from an operating lease with no impairment, where the expense is straight line each month over the lease term. And this is what we expect to see under ASC 842 when we remeasure an operating lease for an impairment. Because at that point going forward, we amortize our right-of-use asset on a straight-line basis, while continuing to calculate our interest expense using the effective interest method. And with that, we've fully covered impairments. For a finance lease, the process is identical, except that once the opening right-of-use asset balance is calculated, the monthly amortization is already correct in our template, and we don't need to update any operating lease calculations. But the outcome is the same. In either case, we calculate interest expense and straight-line amortization for the right-of-use asset. For a finance lease, we record those separately on the income statement, and for an operating lease, we combine them into one operating lease expense. So at this point, we've covered 4 different lessee subsequent accounting topics. First, we looked at periodic accounting, then remeasurements, modifications, and finally impairments. Next, we'll cover lease terminations, our final subsequent accounting topic.